My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today our special guest is someone really interesting because Evan Polaski is not only a real estate investor himself, he's not only a capital raiser himself, but he works full-time for a large company in investor relations. So he kind of gets the best of both worlds. He's working for the big guys, helping them raise lots of capital for their deals, and he's also kind of taking what he learns there, applying it for himself in his own deals as well. So Evan, welcome to the show. Great to have you.
Thanks for having me, Dave. I'm excited to be here.
So let's kind of unpack things. First things first, let's talk about you and your personal real estate portfolio. What kind of properties do you typically invest in? You're based in Cleveland, Ohio. What markets do you invest in personally? Let's just kind of unwrap that right now.
Yeah, so my personal investments span, small correction, I'm in Cincinnati, Ohio, so southwest corner versus northeast corner.
You are, and I was looking right at that, and I said Cleveland instead of, Cincinnati. That's a big insult for people from Ohio, I'm sure.
I don't take it that way. I like it. It's a little bit
everybody else in
here.
Cincinnati does, though. So.
Yeah, all the Browns fans will hate it, and all the Reds fans will hate it. So kind of personally, I've done single family rentals, fix and flips, and then I'm also an LP in syndication deals primarily. And professionally, kind of on the capital raising side, apartments, RV parks are where I've really spent most of my time. And early in my career, some retail shopping centers is where I've kind of raised capital, but less of an investor, more of an employee, versus the more approachable deals for my own scale. For the personal holdings.
Got it. Okay, well, that makes a lot of sense. So tell us a little bit about the day job that you're doing where you're raising capital and you're working with a larger company. Tell us a little bit about that, how long you've been doing that for, and you touched on it, but maybe tell us a little bit more about the asset classes, the number of units, stores, et cetera, that they have right now.
Yeah, so day job is Director of Investor Relations for Axia Partners. What I love about that is I'm dealing directly a lot with people kind of in a similar boat as myself. So, accredited investors, but people that are just looking to make some smart investment decisions with their capital, love the real estate world and the risk profile that it creates. And real estate has just been something that I've loved since a little kid. I've said it in a few job interviews over my career, where I just remember being 6 years old in suburban Atlanta and seeing it was a public anchored shopping center like getting built as Atlanta was expanding, and just being fascinated by it. And it's not unique to retail. It's the apartment complexes, the office buildings. Just always had this passion for kind of the physical world. And
buildings get built.
Yeah, exactly. And at 6 years old, knew nothing about the financial side of it and how people can make a lot of money owning and operating real estate. But I've just always had that passion for it. So, the best part of my job is I get to talk with other people who maybe aren't quite as passionate as I am, but still have a passion enough to want to be investing in it. And then it really comes down to just, sharing, understanding their goals, hearing what they're trying to achieve, and generally trying to make sure it aligns with what we're offering. So that's kind of like the day job and what I love about it. With Axia Partners, we started as a diversified manager. So when I say we own a self-storage facility, a couple RV parks, a few multifamily assets, we did a ground-up development of a 230,000 square foot Class A industrial building. But we've really narrowed that focus down to RV parks, and we love the fundamentals of value-add multifamily in Middle America. We don't love the prices right now. So hopefully that debt cliff that everybody's waiting for might start to reset things to be more viable. But and I should know the unit counts a little better.
Well,
We
that's all right,
own,
but that's kind of
yeah,
you got a diversified portfolio. Well,
yeah.
that's yeah, no, that's what I'm seeing a lot of the larger syndication type companies and larger groups doing these days is pivoting not necessarily away from multifamily, but kind of putting a pin in it for a little while until things. Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. Make sense
Yeah.
again? So
Yeah, I
how
see that.
how
I see that as well.
how has that kind of affected you guys, all the craziness that's gone on in the multifamily space in the last couple of years? Has that
So
affected you guys or what?
not in a meaningful way. I mean, we're holding
Okay.
longer than we had anticipated. Um, but as a relatively emerging manager, we've only been around, we were founded in 2020, but really started buying assets in 2021.
Mhm.
Um, Relative to other vintage deals in 2021 multifamily, ours are still cash flowing. We did take fixed rate debt on those deals. And we've seen some pretty significant NOI growth that we weren't buying in those super heated markets back then. We Kansas City, kind of suburban, some of the smaller markets in Tennessee. But the so we're up 76% or something like that, and 63% on our first two multifamily deals that we bought in 2021.
Mhm.
And yes, you know, we wish we could have sold them by now. We wish that, the market had it. We're glad the market's cooling off, but we also would have liked to
Yeah.
sell those. But we are anticipating, just with the increase in transaction volume that we are seeing. Um, we've built in enough margin and underwrote conservatively with enough room to, we'll still make some very good returns for our investors in those deals. And we're anticipating that those are going to be selling later this year, early next year, probably more than likely. But that would be the biggest hiccup, is operationally going swimmingly. Just we're hoping for that 3 to 5 year exit, and we're getting very close to that 5 year exit at this point.
Yeah. Yeah. Well, you're not alone. You got lots of company in that. That's for sure,
Yeah.
Evan. So you're in investor relations. You're the director of investor relations for the company. What are you guys finding that's working well for you these days for lead generation for new investors besides word of mouth and the referral type thing?
Well, I was gonna say, referrals are always going to be
Of
your
course.
best. It's succeed for your current investors, and they're going to come back for more. They're going to tell their friends. Um, and while we have recently started kind of moving, our latest offering is our first 506C offering, so we're starting to run more social media ads. That's
Hmm.
starting to build some of the traction, um, but it is not the quote unquote for today's deal. It's going to be the existing investors and those referrals thereof, or
Yeah.
personal connections. So it is really tapping into those various networks that you know, I guess there's no time like the present to start building them, but ideally started building, a year, 2, 3 years ago, so that these, people in whatever they are networks, you've already gone through that know, like, and really moving well into that trust category. Um, so a lot of our new leads that are like, you know, ready to invest today that haven't invested,
Hmm.
um, have come from some of the mastermind groups that members of the team are a part of. They tend
Yeah.
to be a little more investment focused. And again, we've been parts of those groups, not just today to start raising money today, but rather, 3 years really adding value to that group, offering the resources that we've utilized, et cetera, um, to then start to tap into that as we have new offerings to raise for.
Yeah, that makes sense. So, Evan, switching gears again back to your own personal investing, how do you take what you learn and what you've accomplished in the day job as director of investor relations? What do
Mhm.
you bring from that into your own personal portfolio? Are you raising capital for your own deals or bringing on joint venture partners? If so, how do you kind of do that without stepping on the toes of the company that you're working for? Just kind of why I'm curious as to how that works.
Yeah, so generally speaking, I'm doing it with my own money.
Hmm.
So I'm not necessarily raising capital when I'm directly buying a deal.
Hmm.
We've done because I say my wife is definitely involved in some of these investments. I've done some joint ventures with kind of close friends, but they they tend to be more. I mean, the two JVs that we've done have been in single family flips,
Hmm.
um, which is something that we've seen some good success in. And so it's different product type, much smaller scale. Um, you're still talking hundreds of thousands of dollars, but you're not talking, the $20 million raise, the 30, 40, $50 million fund, whatever that looks like.
Hmm.
Um, and, so with those, how the day job has related to it, it's certainly helped with my passive investing. So when I've, invested as an LP in either, companies I've worked for in the past or other syndications that I've done, just understanding, I read my first PPM when I was, fresh out of college and was the analyst on the capital raising team for a retail operator, and we were raising an institutional fund. So I was putting together decks and making sure that the fund attorney wasn't like were checking their invoice. They weren't overbilling us
Yeah.
because those lovely marble floor Manhattan attorneys, even back in
Hmm.
2007, billed like $1,000 an hour for partner time. Um, and that's probably only gone up significantly since 2007. But, starting to learn how waterfalls work, how, where fees come in, how they affect net returns.
Hmm.
Um, and I got a lot of insight as to how institutions were looking at deals versus, say, a lot of the marketing that I receive through various channels and for syndication that's focused much more on the high net worth accredited investor. Um, and that's, most institutional investors, they don't really care in a meaningful way about the net IRR that's projected.
Hmm.
They want to understand the asset class, the ability to execute on that asset class, and then the operation side. I sat on due diligence meetings that spent an entire day, entire business day, just focused on the accounting process.
Wow.
Who submits invoices, how AP approves them, who signs them, like how everything flows through, how the property accounts are checking off to tie everything back. I'm anti-money laundering type stuff because these are groups that are going to be writing 50, $100 million checks into a private
Yeah.
equity fund. Um, I have never had a high net worth investor in my day job ask me in that level of detail, especially like how the accounting
I
process
hope
works.
not. Yeah, unless they're
And
cutting you a check for multiple
well,
millions.
yeah,
Yeah.
understood. Like
Yeah.
you don't get the same access when you're writing $100,000 check as you would do when you get $100 million check.
Yeah.
Um, but I think it's good to understand because there's nothing. Every syndicator is an emerging manager at some point, and
Hmm.
you can't have this huge, um, this huge corporate structure. Again, that company was at a different scale, but it was 45 accountants, maybe 50
Oh
accountants. It was
gosh.
one of the biggest
Wow.
departments in the company.
Yeah.
Um, but they had a lot, they had a lot of work to do in that and a lot of
Yeah,
systems
for
and
sure.
process that needed to be
Plus, I
done.
mean, the clientele they were working with, it makes sense. So, Evan, as
Yeah.
we're kind of wrapping up our conversation here,
Yeah.
tell me a little bit about, because a lot of our audience is interested in raising capital and getting
Hmm.
better at talking with investors. That's your full-time gig, my friend. So, if you were to give some tips to newer capital raisers who are talking with investors or potential investors, what would those be? Just big broad strokes.
You got to get into the minutia. And I don't mean that in the conversation, in any specific conversation. I mean that as you need to understand the inside, the in and outs of your business, what you're raising capital for, and everything else. Um, you never lie to an investor. You never make up an answer on the fly. There's nothing wrong with like, I've never gotten that question before. Let me look into that and get back to you, and then follow up with
An
within the
answer.
time that you
Yeah.
outlined. Um, but I always took the biggest compliment as you've actually answered all my questions. Um, and this is from people who said, I've talked to 30 other syndicators and they can't, and like nobody has ever just answered that question. I'm like, well, then they don't know, not trying to,
They don't know that
jab at
minutia.
them, but like, yeah, because you never know. What I love about investor relations is I get to know, I should know and get to know everything about everything in the deal for the most part,
Yeah.
um, without having to do any of it. I'm not taking tenant calls. I'm not
You're
out
not
there
the
in
one
charge
doing
of
the due
keeping.
diligence. You're not the one crunching all the
Yeah.
numbers. Yeah.
Um, I'm not underwriting deals all day long, which I enjoy from time to time, but not like
Yeah.
8 hours a day, 5 days a week. Uh, but it really comes down to like, you know, how do you're never somebody's tax advisor, but you should have a high level understanding of how K1s, what's on them, how they flow through to the typical investor's
Hmm.
tax return. You should understand that, don't oversell bonus depreciation when most investors aren't qualified real estate professionals, nor do they have enough passive income to utilize that huge loss,
Mm.
especially if they're relatively new to the passive investing world, or these types of deals. And so you kind of just need to know that stuff to give people honest feedback. And then the other biggest compliment I got, which again, a compliance attorney might kind of, but I remember one investor, he's like, you're the first person who hasn't just said, oh, you need to go talk to your attorney on that, or you need to go talk to your tax advisor. And I give all those disclaimers, and then I
Hmm.
just talk to him as a human. Hey, I've done passive investing myself. Here's what I've done. Here's what my CPA told me. That might not be the same case for you. So you need to talk to your CPA, but here's a straight answer. You ask a straight question, I give you a straight answer.
Yeah.
Um,
Nice.
and when you get too salesy or too CYA attitude, again, don't
Hmm.
get yourself into trouble. But I think there's a big gray area where you can, be frank with someone and actually directly answer their question.
Well, I think the advantage is you've been in their shoes. You've been the LP before. You know it
Mm,
from both sides.
yeah. And then I'll give one final bonus one is not every investor is the right investor for you.
Hmm.
It's hard, especially in today's tighter capital market,
Yeah.
or capital raising world, where you
You
got a
don't
deal
want to,
under
you don't want to
contract.
turn people
You,
away, but
you don't
yeah.
want to turn people away. You don't want to lose that 50, 100, 200, whatever your minimum, whatever they're going to write check is.
Yeah.
But 9 times out of 10, when you kind of get that feeling of like, this person sort of feels like they're going to be trouble, at least for me, maybe other people's guts don't operate the
Your
same.
spidey senses are
They,
going off, huh?
yeah, it's like you're going to cause me trouble. Like I might get your check today, I might close the deal, but then I'm going to have to deal with you for 4 more years
So
as this
what's
deal
an
runs its
example
course.
of like the last time you kind of politely turned somebody away? What was
Uh,
your
I'm
sixth sense
trying
telling you?
to. It's been very few and far between, but I've
Yeah.
been grateful for it. Um, it, I guess technically I haven't. We have bought out investors after they've been in.
Ah,
Um,
yeah.
because it's just like, hey, this doesn't sound like it's the right fit for you. And normally, if you as either the GP directly or a part of the GP group are saying that, they're annoyed too.
Hmm.
And ideally, this can't always be the case. Thankfully, I haven't run into it firsthand, um, where it's like you wrote a $50,000 check. I'm not saying that's not a lot of money to 90+% of anybody that's doing this,
Hmm.
but it's like we had the resources to say, here's your 50K
Here's your money
back.
back.
I'll
Yeah.
take over your position. You know, you got some extra bonus depreciation because it happened after a turn of a year, but like you're out. I don't have to deal with you anymore.
Yeah.
And then you just make sure you go in your CRM and you unsubscribe them, whether they wanted to
So
be or
is
not.
this in your experience directly or indirectly? Is it just like the nervous Nelly investor that's calling you up every day, every other day or whatever, whenever they see something
It
on the news that's negative about real estate or interest rates or
it
what?
tends not to be that. Again, the one example that I was an investor that really was hitting on how much depreciation is going to get passed through on my K1.
Hmm.
And it's like, we don't know
Yeah.
until everything's, because there's a lot of factors that go into it, not just the cost seg study, but if you're buying it, if you're going to start operating it midway through the year, like you're going to have other things that you're going to be able to write off, some that you might not. Like it just, the numbers move until the year is end and over and the bookkeeping's done.
Right.
And this one particular deal, uh, he had asked for kind of what's this look like, and I pulled together here's like I don't know how many, like 20 different K1s, like year one K1s that we've issued. Here's the average. And I sent it to him like, this is the historic average. And it ranged from, this number
Yeah.
much lower than the average to this number much higher than the average. But here's a general
Yeah.
sense. If
You
this is
did
what
the
you're looking
best you
for.
could to answer the question under the
Yeah. And
circumstances.
this guy in particular, or this deal in particular, happened to come back towards the lower end
Mhm.
for various reasons. And he was just pissed. Like there's no real. I don't get it. We're not talking a huge dollar amount, both from an investment amount, from a tax savings availability. Like the variance that I was off was, if you take 31% of that, you're talking like $2,000,
Yeah. Yeah.
maybe a little more, like $4,000, but not a meaningful for most accredited investors variance.
Yeah.
And he was just like throwing a hissy fit, for lack of better terms.
Yeah.
And, we just said, sounds like this, we were off. We're sorry. We didn't misrepresent anything, but like,
Yeah. Yeah.
here's your money back. Will that resolve it? Because again,
Yeah. If
it's
that's
not
how the
just
guy
keeping
was
it
acting with something small, then something big would
that,
be
and then he
complete.
gets onto online forums, which there are ample
Oh
amounts
my
of ways
goodness.
for people that can talk about for better and worse.
Talk smack about you. Yeah.
Yeah, and it's one thing, syndicators who I think aren't scam artists, but are definitely got in like thought they knew more than they did and raised a whole bunch of money because they're great marketers, and then things go south. And I
Hmm.
feel for the investors that's happening to, and I to a certain extent sort of appreciate that like people can talk about that. But when it's we were off, $13,000 on our estimated bonus depreciation, of which you only yield 30% of that, like
Hmm.
you're gonna talk about that. And he didn't. Maybe he never would have, but it
I
kept
get
him
it.
happy. He got his money back, and you
Everybody's
walk
happy.
away. Yeah.
Evan, time flies when we're having fun. If people want
Yes.
to connect with you and find out more, where should they go?
Best way is LinkedIn, and I will spell my name very quickly: EvanPolaski. You'll probably also see on the screen captures, or any other things. But
Yep.
yeah, feel free to message me there, connect with me there. Always love talking real estate.
Awesome, Evan. Thanks for being on the show.
Thanks for having me, Dave.
All right, everybody, take care, and we will see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.